So we're absolutely honored to have Mohnish Pabrai here with us today. In 1991, Mohnish Pabrai started his own IT consulting and systems integration company, Sunteck, with $100,000. He went on to sell the company in 2000 for $20 million. In 1999, Mohnish Pabrai started his own hedge fund, Pabrai Investment Funds, with $1 million. Today, he has over $500 million of assets under management, has successfully employed a market-beating, value-oriented global investing approach for over 20 years. Mr. Pabrai is also the author of The Dando Investor and Mosaic Perspectives on Investing, both of which are must-reads for any value investor. Mr. Pabrai is also famous for paying $650,000 with his good friend Guy Spier for an invaluable lunch with Warren Buffett. Mohnish Pabrai is also incredibly generous, giving away approximately 2% of his wealth every year to the Dakshana Foundation. The foundation provides tutoring services to some of the least privileged members of Indian society, which enables them to attend elite institutions of higher learning. Thank you for joining us today, Mr. Pabrai.
Itai, it's a pleasure to be with you. Looking forward.
Excellent. Thank you so much. So let's start with the questions. When studying the selection of spawner stocks in your portfolio, our students found two common mechanical filter threads. One was that, as you mentioned in previous interviews, there was a maximum market cap. They were sort of looking for all of these spawners. And the other trend that we saw, that there was a lot of high insider ownership within these companies. Are there any other sort of mechanical factors that you use to narrow down your selection when looking for multi-baggers using platforms like Capital IQ, for example?
Yeah, so actually, anytime you mention to me mechanical filters, I cringe. So in general, it's probably not a good approach to investing because the real world is messy and individual businesses are messy. But one of the things that is very powerful about the spawners is, I can maybe give you an example. I own a portion of a company in India called Indian Energy Exchange, IEX. And IEX basically is effectively it's a monopoly business, and it allows the trading of electricity between generators and the discoms, the distribution companies. And they collect an approximately 1.5% fee of the amount transacted. And so basically, currently, I think, I mean, when we invested, approximately less than 3% of India's total electricity usage was going through IEX, and now it's over 6.5%. So in terms of the percentage increase in the last 3-4 years, quite significantly, but also per capita consumption of electricity is going up as well. So the business has many tailwinds. They also started another business called Indian Gas Exchange and so on. That business basically produces 80% operating margins. So if they take in $100 in revenue, something like $80 is pre-tax profit. And then after you pay maybe 25% taxes on that, you still have like 60% after tax. So it's an extremely profitable business. And as it scales, that profitability only increases. They have no real good way to use that money that's coming in. And so they only really, for the most part, have two choices. Either they can dividend out to shareholders and or buy back their shares. On the other hand, if you look at a business like, let's say, Tencent in China, Tencent basically is also a business that generates very high returns on equity, and it's not as good as IEX in terms of 80% operating margins across, but it's very healthy. And they generate tens of billions a year in free cash flow every year. But inside Tencent is what I would call Sequoia fund on steroids. So if they make 15 billion in a year, free cash flow, they have a biz dev arm that is going to take that 15 billion and deploy it into mostly private deals. And they are also very thoughtful about it. So they're not, sprinkling money around to early stage businesses, etc. They focus on businesses that have achieved certain milestones and certain traction, and then they'll come in. They also tend not to want to have large stakes because they want to leave incentives for teams. So their engine, which feeds this BizDev arm, has been very successful. They've invested in what have later turned into more than I think 15 or 20 unicorns, and they've done really well. So what I'm saying is they have an engine which takes their cash flow and puts it into other businesses, and that business, that engine, the track record of that engine can go up against the best venture capitalists. It's extremely good, and there's no carry, so it's even better for investors. That engine that Tencent has is extremely rare. Most companies that are even really good businesses like IEX do not have the ability to redeploy the money that's coming in into other businesses. If you look at a business like Berkshire Hathaway, for most of its history, so Berkshire from 1965 till now has never issued a dividend. I think one time Buffett, I think the record indicates that they one time issued a dividend of 10 cents. And Buffett said that he must have gone to the bathroom while the board made that decision. But he said he's never after that ever stepped to the bathroom during a board meeting. And so there's been no dividends other than the 10-cent dividend on what is more than a $400,000 stock today. But from 1965 until very recently, maybe in the last few years, not only did Berkshire not issue a dividend, they did not buy back their shares. The buybacks have started more recently because even an amazing capital allocation engine like Berkshire has not been able to find enough opportunities to redeploy the capital into, which worked extremely well for more than 40 years. So if you have a great business that's spinning off lots of cash, I mean, Berkshire, for example, had made a very early investment when they bought See's Candy, and See's Candy has been nothing but a money spinner. But it has no ability to use the cash that it generates. But the Berkshire engine was such that they didn't need See's to use the cash. They took the cash flow from See's and they bought 100 other businesses. And they were really good at that. So that type of prowess of redeployment of cash is rare. And spawners, coming to spawners. So if you take a business like IEX, IEX actually is a spawner. The first spawn they've created is Indian Gas Exchange, which they're trying to grow and scale. But by its very nature, Indian Gas Exchange hardly needs any capital. It's like Indian Energy Exchange that also hardly needs any capital. So even if it's really successful, it will not be able to use the capital. So even though they're a spawner, they really can't do much with it. So the difference between, let's say, a Berkshire Hathaway and, let's say, an Amazon, the difference between these two is, in the case of Amazon, the redeployment of the cash generated is mostly done with internal projects. So they basically are spawning new enterprises and new adventures and so on. In the case of Berkshire, a lot of it is acquisitions. Not that much coming from internal redeployment. They do have some amazing businesses that are redeploying internally, etc. but for the most part, they've got to go externally. So if you look at the kind of the hierarchy, the absolute best way to use capital is if you have a spawning engine internally that has a high hit rate and is spawning businesses that generate high returns on equity. That's, that's Mecca. You've hit the top spot there. The second is if you can't do that and you can buy or invest in other businesses or assets at valuations that would give you high returns on equity, that's also excellent. The third would be either dividends or buybacks. And buybacks actually can be extremely powerful if they are done at modest valuations. If you look at a business like Mastercard, so Mastercard does a lot of acquisitions. They have very high, net income versus revenues, etc. Fantastic business, but they still end up with lots of cash. And even though the business trades at a very high multiple, they still continue to buy back shares because they've got no other option. So it's way better to buy back Mastercard stock at 10 times earnings than 40 times earnings. But even at 40, it still works, but it's not that great. So spawners are basically sitting pretty much at the apex of the pyramid, and which is why we like them so much.
So we had questions discussing some of the other factors that go into spawners. So for example, Tencent, they managed to actually, despite the Chinese government having a lot of antitrust policies, they did manage in some of their departments to have a monopoly. Tencent's music had exclusive licensing agreements. Now the Chinese government is really cracking down on those. So how do you evaluate that aspect, or how do you evaluate, for example, real estate companies in Japan that may be spawners who banks, there are some recent events that of some frauds in that area that banks sort of are more hesitant to lend to them now?
Yeah, so I'll sidestep stuff which goes into current portfolio holdings. I think that just gets in an area I prefer not to go into. But I would say that there's a blogger I follow in China. I think she was saying that, and I hope I can remember this correctly, but she was saying that in China it was or it is innovation and then regulation, and in Europe it's regulation and then no innovation, and in the US it's innovation and no regulation. So you've got these different, I think this is kind of a wide paintbrush, but the bottom line is I think that there are very few things that I have noticed that have happened in China recently that I would be scratching my head about. So, for example, in my nonprofit adventures with the Dakshina Foundation, I have spent 14 years examining the for-profit sector of education in India very closely, and we've even had them as vendors, and paid them to provide services to our students, etc. We had a very long history with the Indian, let's say, tutoring industry, which is the exact same industry that the Chinese government cracked down upon. The Indian government also is extremely upset at this industry, and from my point of view, rightfully so. And I don't think of the players in that industry by any stretch of the imagination as being high quality. I think they're, I would say, ruthless capitalists. And so if you just, and I'm going to use that as an example to just go to the others. If you have a situation where a set of universities or university has 10,000 seats, and there are 1 million people aspiring to get those seats, which is somewhat similar to the situation with the IITs in India, the 10, 15,000 seats and north of 500,000 to 1 million kids interested in those seats. There's a basic problem of a large number of students interested in a very small number of seats. Anytime you have that situation, capitalism is going to lead to enterprises that come up with trying to find ways where they'll say that if you give me X, I can increase your odds of getting that seat. And in an unregulated world, that type of capitalist endeavor is going to go bananas, which it did in China. So what ended up happening in China is that every Chinese parent wants their kids to go to the best schools, and all these for-profit education companies come up and say, look, if you want to go to Peking University or Tsinghua, whatever, we are the toll bridge that you have to pass through. And the toll bridge has two costs. It has a dollar or RMB cost, and it has a lot of effort cost. And the end result of all of that is that Chinese couples come to the conclusion that they really can't have very many kids because it's so expensive and so draining and so complex. So I think the government has its heart in the right place when it says, we don't want this kind of a system because it reduces people's interest in having reasonable sized families, etc., which goes against the country's things. But on the other side, the problem that this type of situation has is there's no easy answer. Anytime unless you increase those 10,000 seats to 100,000 seats, or you give people other avenues, which the CCP is trying to do, it leads to a quandary. And like there was a joke, I think, on Twitter that these for-profit education companies in China have converted their facilities into high-end cafes where you go in to have a coffee and then you sit down at a table with a very high-priced tutor who, ineffectively continues to tutor you, but you just pay for the coffee. And the coffee, instead of being $5, is $500. And so you kind of sidestep. It's just a coffee shop, so it's kind of funny. But anyway, so I think that on many fronts in China, it is actually healthy for the country to have a robust competitive environment. And I think in the case of the large players in Chinese tech, they're pretty high quality players, but in many cases, the rules were not defined. And so, in a Wild West scenario, you're not really breaking any laws. You're just proceeding with what's acceptable in the Wild West. And so I think the Chinese government coming down and saying, hey, wait a minute, I think some of these things, if we, tweak it somewhat, at the end of the day, we end up with a better ecosystem. And I think that's what they're driving towards. So that's my 2 cents on that.
Okay, thank you. Really appreciate that and that feedback. And another question is, how effective of a method do you think that it is to try and find, let's say, for example, Mastercard and Visa, where they have a great business model in the US and in a lot of countries, but there are some countries like China, for example, or some other countries where those companies aren't there. So how good of a investing strategy do you think is it to find those types of companies in those other countries and try and analyze those?
Yeah, so I think, first of all, just to digress a little bit, payment systems in the US are way behind payment systems in almost any other part of the world. Payment systems in China are extremely advanced, Korea very advanced. And actually, in many ways, the US payment system is very archaic. And it has an extremely high frictional cost. So one of the issues that comes up is that if I'm a small merchant, doing some small e-commerce site online selling to consumers, I have to pay the Visa Mastercard ecosystem 2 to 3% of my top line, which is a ridiculously high charge for enabling payments. If if I were to use my bank or if I were to use other avenues, it would drop to, it would drop it by more than 95%. And so one of the things that we've seen is that companies have come up like Affirm and others, which are basically trying to sidestep the Visa, Mastercard ecosystem by saying, okay, let's spread the payments out, 3 or 4 payments. Now that 2% is gone. So the 2% or 3% that they're taking, in some ways it does come back to the consumers, because most of us have an IV drip of airline miles coming to us through the credit cards, and so there's a arms race on that front in terms of I'll give you more and more. So there is some kickback in effect coming to the consumers, but in general, the US, because of the moat of these companies and because of the kickback mechanisms that have been put in place, it makes it really hard to disrupt them. In the other countries like China, etc., they weren't there to begin with. And so the merchants weren't interested in suddenly saying, oh yeah, please take 2%. And I'm really happy about that. So I think payment systems in general are an area of rapid change globally. Some of the moats in the US are pretty strong, but they're going through a lot of changes all around the world. And so, so when you're investing in payment systems, you have to be aware that it's a moving target. And sometimes you can end up with very deep, enduring moats, like the way Visa and Mastercard did. To some extent, even you can say Alipay, Tencent Pay, they've also developed some great moats. But it can shift. Those are industries with rapid change, so one has to be a little careful.
Yeah, absolutely. Thank you for that. That's very helpful. And students saw that we read Nick Sleep's letters, and we saw about scaled economies showed how powerful of a business model that is. And then you also bring up a lot like a recycling/funeral services business model. Are there any other business models that you think you see are very, very powerful?
I mean, I think it's in the eye of the beholder. And I think it's in what is very useful is to just take a step back when you look at different businesses. Just take a step back on the nature and quality of the business. Buffett says that there are some businesses that are so easy to run, and that you could have an idiot running those businesses and they would just keep doing well. If you are a Coke bottler, for example, you have a monopoly territory given to you by the Coca-Cola company. You will compete with a Pepsi bottler, but you will not compete with another Coke bottler, right? And the joke with the Coke bottlers was that as the owner was dying on his deathbed, he would call his kids, and as he's taking his last breaths, he would tell them, whatever you do, don't let them change the contract. And then he would die. Okay? And then when the kids are dying, they would tell their kids, whatever you do, don't let them change the contract. And then they would die. And because the bottom line was that they had it was great because they bought syrup concentrate from the Coca-Cola company, and Coca-Cola company made a good bit of money on this syrup concentrate. That's like a software business if you really think about it. But then they control the rest of it, right? The distribution and the pricing and all of that. And because of the brand, you're not going to buy Glot's Cola, and such. So you're going to do quite well with it. So I think the thing is that when you look at a business, it's a very wide spectrum of companies. Some businesses are in this very favored situation where the moat is wide and deep and can endure for a very long time, and it generates high returns on equity. And most of capitalism is not like that. Most of capitalism is dog eat dog. It's really tough. It's difficult. I mean, if I wanted to, for example, have the windows of my home cleaned, okay, I mean, I would go on Yelp and have a few window guys give me quotes. I mean, they have to be very competitive. If they've got a really good reputation, they might be able to get a little bit of a premium for that, but it wouldn't be much. And so there are lots and lots of businesses, which is the bread and butter of capitalism, where you're just going to have to be amazing at execution and amazing at everything. Whereas the Coke bottler can be extremely poorly managed as long as the plant is running okay and you're not putting poison in the Coke bottles. Life is going to go on and it's going to do well. It may not be doing as well as it could do with great management, but it'll still do well. And in fact, I would guess that most Coke and Pepsi bottlers are undermanaged for that. In fact, one of the other things that comes up in capitalism is the businesses that need to be extremely well managed to survive do end up being well managed, because otherwise they're gone. And the businesses that can, deal with a lot of slack and still stay alive are generally going to have slack in them.
That's very interesting. Thank you for sharing that. And then you discuss a lot how investors with small amounts of capital should be able, if they're very talented, to generate 40, 50% IRRs. You've mentioned our students want to know what really should they focus on. You've mentioned net nets in the past, for example, but there are plenty of those in Japan that don't re-rate or take a long time to re-rate. So should it be net nets with a near-term special situation re-rating catalyst? Should they focus more on real estate discounts to NAVs rather than cash discounts? Look for future 1x PEs, cheap earnings, and discount to NAV, etc. Do you have any more guidance in that regard?
Yeah, all of the above. So I think what you want to do is, I think it's really useful. It was really useful for me to set an absolute target. Okay, so let's say your absolute target is that I have a very small amount of capital and I want to double it every 3 years, for example. What that means is you need to be generating about 26% a year or something. So which means that you really can't buy a business at 80% of intrinsic value, because even with some growth and stuff, it would be hard to get a double in 2 or 3 years. But if you are able to buy an asset which is worth $1, but you were able to buy it for 30 cents, that may lend itself to something like that. And so the range of assets that can give you that outcome can vary a lot. So it could be a distressed bond. So it could be a high yield bond where the annualized return till maturity exceeds 30% a year. Now, most bonds where your coupon is 30% a year are there for a very good reason. You're likely not to get the coupon and probably not get your money back. So good luck with that. But sometimes things get mispriced. So for example, Charlie Munger made an investment, I think in 2002, in Tenneco. It was very distressed. He bought the common and he also bought the bonds. And the bonds were at, 20, 30 cents on the dollar. And even the common was really clobbered. And it worked out extremely well. I think in about 3 or 4 years after that, the 10 million was 80 million. So that worked well. So I think the high returns with low amounts of capital is definitely there. And one of the things that Joel Greenblatt points out is, let's say I am extremely good at identifying opportunities where I can get a 50% annualized return with my $1 million. Let's say I have $1 million and I'm really good at finding things which will give me 50% a year. Well, if I am successful at that for any period of time, in a few years, I'll have 10 million. Okay. And then I'll be looking for opportunities to put the 10 million to work. And I may no longer be able to get 50% a year, but I might be happy with 30% or 20%, right? So what that means is that I have left the arena of the 1 million 50% compounders because they cannot move the needle for me. And when the 10 goes to 30, it really cannot move the needle. So many times when I look at a business, so, I manage like let's say 750 million or something. When I look at a business sometimes where the total capital I can put in is 2 million, okay, and it has a very high return, I don't spend my time looking at that business. It's going to take effort to figure it out. It's just not worth it. The amount of capital I can put in, whatever I can put in, is just not worth it. So even though I may like that hunt and all of that, I have moved on. Now, when I started out, I was running a million. I'd be all over that, right? So what happens is as investors get more and more successful, they move up the chain and they leave the low end to new entrants. So the low end is always there for a young enterprising person, okay? And I want to tell you a story which I think you guys might relate to. So one of the things about human nature and our psychology and who we are is after the age of 5, it never changes. So from the age of 5 to the age of 95, who you are and what your likes and dislikes and traits are hard-coded. And to lead the best possible life, you want to have your behavior patterns align with what your inborn traits are. Because inborn traits are frozen. If your behavior doesn't align with the inborn traits, then you will have suboptimal results. So when Warren Buffett was a kid, he used to go to the Exor racetrack in Nebraska. And the Exor racetrack, Exor is Nebraska spelled backwards. And in fact, one year, I think I went to the Berkshire meeting, I think in the late 90s or early 2000s. The meeting was at the Exor track. The track had closed down, it had become a meeting venue. So he used to go to the racetrack and he had a number of different interests in horse racing, but one of the things he was very interested in, at the end of the races, he would pick up all the tickets that people had thrown on the grounds, and he would gather them all up. And then one by one, he'd go through each one to see if some drunk had thrown a winning ticket. And as you know, there's a lot of alcohol consumed at the Exor racetrack with either people who are drunk or just don't pay attention. And every time he would find some tickets that actually had money in them. And because he was under 18 and it was illegal for him to do betting, he used to send his Aunt Alice to the window to collect on the ticket. So he'd collect all the tickets, then he'd send Aunt Alice to, collect. And he did that, through high school, whatever. And then when he became a value investor, and when he started his own fund, he sat down with the Moody's manual. And the Moody's manual, let me just see if I have a Moody's manual here, just to give you a visual. I'll be right back. Give me a second.
Great, absolutely.
Yeah, I think the Moody's manual I have is in my office, so I don't have it here, so I couldn't. But if you go on eBay, you can find some and look at it, whatever. I bought some on eBay just for nostalgia's sake. But the Moody's manuals are pretty thick. Okay, they're like encyclopedias, and they're very fine print, and they have like 3 or 4 companies with a lot of detail in one page. Mostly it is the quantitative data of these companies, kind of revenues, cash flows, assets, liabilities, that sort of thing. Just the income statement, balance sheet, and that sort of thing. And there were tens of thousands of companies in these Moody's manual. And Buffett went through every single company 2 times through all the manuals. It's a lot of work. I mean, he literally from 7 a.m. to 11 p.m., other than for meals, that's what he was doing. And for him, it was exactly the same as the Exarban exercise. What he was looking for is something weird that people had missed. So he would find, for example, some insurance company where the market cap was 15 million and 1 year's earnings were 25 million, right? And so these were the winning tickets that people had thrown away. And he would find these companies. Then he would, once he found weird things, he would research it, and it was real. Then he'd start buying the stock, etc. And um, he even after he got influenced by Charlie Munger, and he started buying better businesses. Probably I would say a few years back, I would say maybe 10, 12 years ago, I was in his office with my friend Guy Spier. And, I had lunch with him in 2008. And after the lunch, setting up the lunch and all that, I got to know his assistant quite well, Debbie. And so Guy and I asked Debbie if we could take her to lunch before the Berkshire annual meeting. And she said, "Oh yeah, that'd be great." So she said, "Look, the meetings on Saturday, Fridays are really busy because there are all these people coming into town. But if you come on Thursday, I can go for lunch on Thursday." So for several years, Guy, me, and Debbie used to go for lunch on Thursdays. And to me, the lunches with Debbie were way better than the lunches with Warren. Okay, I mean, we really got the lowdown of what was happening from Debbie. Okay, Buffett has a veneer of diplomacy, but Debbie was awesome. So anyway, I think we'd go to Berkshire headquarters to pick Debbie up, and then one year I think Buffett was we were very surprised. We went up the elevator, and he was there at the when the elevator came up on the 14th floor. He was there at the entrance waiting for us, and I thought maybe he's waiting for the elevator to go down. But he said, "Would you like a tour of headquarters?" And we said, "Oh yeah, sure. If you're twiddling your thumbs and you want to give us yo-yo's tours, we're all for tours." And so he took us all over, showing us all the memorabilia and all of that. And then we went to his office, and I noticed he had Japan Company Handbook in his office. And the Japan Company Handbook is the same as the Moody's manual, except it's like value line with half a page for each Japanese company. And he was going through it. So I now Warren was 80 years old, and Exarban was an exercise he was doing when he was 12 years old. And the Moody's manual was something he was doing when he was 25 years old. All three exercises are exactly the same. Okay. And the amazing thing is, when he's 80 years old and he's managing hundreds of billions of dollars, he knew he can find nothing in there that can move the needle for Berkshire Hathaway. Okay. It's like, like I told you, the $1 million guys have to move up. They can't stay there. They're going to move up. But the thing is, he loved the hunt so much that he couldn't help himself. And probably if he found something in there, Berkshire couldn't buy it. He probably could buy it for his own account. And he did that with Korean stocks a few years ago, where again, it was the exact same thing. It was quantitatively cheap and he couldn't help himself, right? And so that is the nature of this investing game, is that there will always be winning Exarban tickets on the ground. And the only question, Itai, is, will you bend and make some effort to pick them up and analyze them? So if a person is interested in doing that, I mean, I think that, there's we have these ancient Indian texts, the Upanishads. They are spiritual, but I think they're very heavily philosophical. And I think there's a quote, let me see if I can remember it. They say, "As is your wish, so is your will. As is your will, so is your deed. As is your deed, so is your destiny. And then the punchline is your deepest desire is your destiny. So if you really, really want something, okay, Buffett really, really wanted to find every single winning ticket that anyone had ever thrown away, right? And so he just went all in on that, right? So if you're willing to go all in and search in the nooks and crannies of the markets, you will find lots of treasures. But you've got to be very passionate about it. And like, I mean, the thing is, I've talked about in some of my past videos that, in 2019, I was visiting Turkey, and I visited this company where the market cap was 20 million and liquidation value was like 500-600 million. Hallelujah. We're at the Exor racetrack. And except that in this case, there's millions and millions of dollars on the ground. Nobody wants to pick it up. The entire country of Turkey, 80 million people, have no interest in picking up these Exorbitant tickets. So the Indian guy from Bandra in Mumbai in India has to go there and do the job for them. It's okay. I'm happy to do the job. And then, in 2015, there was my PE of one, this company, Rain Industries, I found, and no one was interested. We've got 1.3 billion people in India. They're not interested. And it's okay. I'll help them out. And that's fine. So they are there. They are there in plain daylight. But you've got to be focused on the hunt. And it can show up in very different shapes and forms. And but if you're focused on that, it will happen.
And when you find one of those that's either, let's say, a very low, let's say, earnings power multiple, or something that's at a huge discount to book value, how important is it to have a near-term tangible catalyst for the stock to re-rate? Or do you just feel like the discount is major enough where it'll just re-rate anyways if you've made the correct choice?
Yeah, so I was telling you that the quantitative stuff you got to be a little careful about. Book value, if a company is trading well below book value, it doesn't mean it's worth book value. Okay, it could be worth well above book value, or it could always be worth well below book value. So we cannot just use quantitative screens alone. Or if some companies are a low PE, it may deserve to be a low PE because in 3 years it might be gone. Okay, so it deserves to be at a PE of 2 because in year 3 it's not there. So I think what we have to do is that when we find things that are statistically cheap, it's only the beginning of the hunt. When something is statistically cheap, and it can be cheap on a number of different ways, we then have to roll up our sleeves. And the first question we're going to ask ourselves is, what I'm looking at, is it within my circle of competence? And can I figure this out? Okay. And if the answer is yes, then I can go further to the next question and so on. And so I think we have to, even when Buffett started with the Moody's manuals, he was looking for things that were statistically cheap, but he had an awesome business analyst mind. So he could then go from there to looking at, well, how real is this and what's going on here and all these things.
Thank you for that. We really appreciate it. And a lot of students were interested in getting some advice for you on how to start a fund in the future. So how do you initially raise capital for the fund, apart from the 0.25 fee structure that you highly recommend if you do not have, let's say, relatively rich friends and family to raise it from? And also, how much capital do you believe that an investor would need to start a hedge fund today or to manage their money full-time in the US?
Okay, yeah. So I would say that before we get to the raising a fund question, what should have happened before that is 10 years or 50% a year. So if you, for example, had very modest amounts of capital, I don't know, 50,000, 25,000, 10,000, for example, at 50% a year, it becomes a significant number. So if you have $10,000 and you haven't been able to do, 30, 40, 50% a year for a long time, then I don't think you should even think about a fund or anything. And the second is that if you've got an engine which is getting you those high rates of return, the power of compounding is such that if you never raised the fund, you would still be enormously wealthy. So I think the first criteria to getting into the fund business is you should already be independently wealthy. And if you are not already there, it means that something's happened in the past where it hasn't been proven that you can do this. Now, if you're already wealthy, then I think you focus on the friends, family, and fools, especially the fools. Okay, and Buffett says that if you have a great track record, they will swim to you in the middle of the Atlantic in shark-infested waters to invest with you. So if you have done well, people will find you. And so you don't need to be great at raising capital. You need to be great at pounding out great returns. If you pound out the great returns, everyone's looking for those managers and they are trying hard to find you, and they will find you. So when I started my fund, I had $1 million from 8 investors who actually asked me to manage money for them because I used to give them stock tips and they'd done well with that. But then after I got the fund going, and the SEC puts a lot of restrictions on, you cannot solicit, advertise, all these things. But they don't stop me from talking to my existing investors. I can talk to my existing investors about anything. So I remember the first annual meeting we had, which was like 8 brave people around a conference table. And we met and then we went for dinner. I told my investors at the time that, do you know why you have been put on planet Earth? Do you know your mission in life? They said, no, why don't you tell us? I said, you were put on planet Earth so that you might bring in assets to Pabrai funds. That is your mission in life. So one thing to understand about humans is most humans have no idea why they are on Earth. They're looking for a mission. So just give them the mission. And so I said, please go to your closest friends and family and tell them about me and ask them to contact me. And, then I can talk to them, because once people contact me, then I can talk to them. It's just that I can't, speed dial all the dentists in North Carolina and say, please invest with me. The SEC wouldn't like that too much. So I just told them that was their mission in life. And they went out and, executed on that mission. So we went from 8 investors to 17 investors to 25 investors, and we just kept going from there. And then when those new investors came in, I also had to educate them on what their mission in life was. And we just kept going from there.
Yeah. Thank you for that. That's very helpful. And in the past, you've talked a lot about both Fiat Chrysler and about Ferrari. Stellantis today owns for Fiat Chrysler, and then Exor has a stake in Ferrari. Do you have any thoughts on either Stellantis or Exor?
Yeah, I think so. John Elkann, who's the chairman, is a good friend of mine. I got to know him quite well once I had a ownership stake in Fiat Chrysler. And so anyway, I think one of my deep regrets is that I used to own like more than 1.3 or 1.4% of Fiat Chrysler when I first invested. With a 5 billion market cap, we put in about 70 million or so. And then they spun out Ferrari. And, I got 1.3 million shares of Ferrari in that spin out. And again, my ownership of Ferrari was over 1%. It's amazing, Every 100 Ferraris sold was for the benefit of Pabrai fund investors. How utopian is that? And then in my infinite wisdom, overly focused on the PEO ones, Ferrari's trading at 30, 40 times earnings, I sold it. So I think we made like 100 million on Ferrari, but if I had done nothing, we would have like 300 million of Ferrari stock today, which would be very nice. I think Exor is a good allocator of capital. I think they've done some very good things with the way they've approached things. And I think John is young, and I think he has a long runway ahead. He has a good team. So I would expect that he will make good decisions, and I think they will do well in the future. Yes, absolutely.
Yeah, interesting. Thank you for sharing your thoughts on those. And we haven't had an update in a while on the contest between you and Guy Spier of Sunteck Realty versus Mastercard. How are you feeling about your position? And I know it's still in the early innings, but how are you feeling right now about that?
I think I haven't looked at the numbers lately, but I would guess Mastercard is probably ahead. I have to go back and look at that. But I think it's a long contest, and Sunteck is actually just beginning to kind of hit its stride right now. There's a lot of tailwinds coming in. Their business has gone very capital light, and so the night is young, and we shall have to see what happens in the next 5 or 7 years. But that'll be I think that I was much more biased towards the PEO1s and all of that when I made that bet, and I'm more biased towards the compounders now. I don't know if I would place that bet today, but I couldn't tell you which one's going to win right now. We'll have to see.
Okay, that's very interesting. Thank you for that. And then people are wondering if you've read a book that Nick Sleep rates really highly. It's called Zen and the Art of Motorcycle Maintenance. And if so, what are your thoughts on that book?
Have you read that book, Itai?
I have not read it yet personally, but it's in my plans for the next book that I read probably.
Okay, yeah. So I did read Zen and the Art of Motorcycle Maintenance. I also found it difficult to read, and I could not get out of it what Nick Sleep got. So Nick Sleep, that particular book, had transformational value for him in a number of different ways. It did not have the same. I think towards the end of the book, I started to understand more of it. But I think so. I would definitely say that it's worth picking up the book and reading it, just to see if it is something that resonates. So I couldn't get to Nirvana with Zen, but there have been other books which have resonated a lot with me and have helped me a lot. And so I think each one of us, our receptors are different at different times, and we're able to pick up different things at different times, and then that can work. But the book was very successful. It got translated in many languages. I think he did the author was turned down by 50 publishers or something before anyone took a chance on him. And then it became a runaway bestseller. So it is, what I did find easier is I switched from reading it to listening to it on Audible. And that definitely went better for me. The reading was going very slow, but I think it's worth reading, sure.
Excellent, thank you. Excited to check it out. And for our concluding question today, what would you say are your favorite books about either startup founders or former CEOs of companies?
Yeah, I would say that founders, I would say Sam Walton's book. I think that's really good. Business biographies and business autobiographies is probably my favorite genre because I just love them so much. And for example, recently I read a book which was written by Sol Price's son. So Sol Price was the founder of Price Club, and Jim Sinegal at Costco used to work at Price Club. Then he started Costco, and then eventually they bought Price Club. So they asked Jim Sinegal, I think a few years back, what did you learn from Sol Price? And he said, it's the wrong question. He said, there's nothing I know that did not come from Sol Price. So everything I know is from Sol Price. And so I think when you go through business biographies and autobiographies, there's a wide range. I really enjoyed The Making of an American Capitalist by Roger Lowenstein. But I think that there's so many biographies and autobiographies that have come out over the years that I think can uh, help you along quite a ways. Like I'm reading right now this one, Invent and Wander. This is the Bezos writings, but also the intro by Isaacson is really amazing. So I think whatever you can do to uh, read about autobiographies of founders or biographies of 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 entrepreneurs, I think it's tremendous because you get to see things from the lens that they're looking at, and you could see them in so many different industries. So those are wonderful.
Absolutely. Thank you so much. Really appreciate it. And we really appreciate you taking the time out of your schedule to meet with us today. This was an extremely helpful session, and the students really, really value it.
Well, Itai, I'm happy, and I think it was a fun session, and I think it sounds like you did your homework, and I think I enjoyed the interaction, and I enjoyed the questions. So thank you very much.
Yeah, thank you. We highly enjoyed it as well. Have a great day, sir.
Okay, thanks.
Bye-bye.
Bye.